Mary, kindly mute. Okay, thank you. Welcome to today's lesson. Today we're going to do an introduction to financial management. Financial management is one of the topics, units in MBA second semester. So this will be our first topic, and it is basically an introduction to the unit and what to expect in this unit. So just from the term financial management, we'll be talking about managing finance, or basically we'll be talking about money. We'll be talking about money. So financial management is a discipline concerned with the generation and allocation of scarce resources, usually funds. So here we'll be talking about generation and allocation of funds. So that is financial management. The ability to generate and also to allocate funds. This unit is very important because it is very applicable in real life situation. Because there is the aspect of generation of funds. For example, if you have a project, and there is also the aspect of allocation of funds. And here we are talking about generation and allocation of funds to the most efficient user within the firm. So maybe we are talking about projects. So a firm requires resources in form of funds raised from investors. So this unit is applicable in real life situation, at an individual level, and also at a company level, because you're talking about generation and allocation. But you're also going to look at other aspects of finance, whereby we are going to talk about sources of finance and the aspect of liquidity. But for now, let's focus on these. So a firm requires resources in form of funds raised from investors. Each and every firm requires funds. Funds to run the project, to run company projects, or funds to pay salaries and all that. So the funds must be allocated within the organization to projects which will yield the highest return. So there's a topic called capital budgeting, whereby you're supposed to weigh the options when it comes to investing. The ability, we'll be talking about the ability to make investment decisions. Why would you prefer to do a certain project and not a certain project? Why did you prefer to go to school other than using that money to do farming? So there is the aspect of allocation of funds to the highest return yielding project. So for the purposes of exam, we are also going to learn about the slide 2, scope of finance function. These are questions that you can be asked in the exam, the scope of finance function. So the functions of finance manager can broadly be divided into two. We have the routine functions and we also have the managerial functions. So basically, we have said you're talking about financial management. And in a company, we are going to look at the functions of this person called a financial manager. And as I've said, it does not mean that it is all about a company. It can be the functions of a financial manager at an individual level. So, but in this case, we'll talk about the scope of finance is divided into two. We have the routine functions and the managerial functions. Routine functions are the day-to-day activities of a firm and or weekly activities of the firm. Then now we have the managerial functions. So, managerial finance functions require skillful planning, control, and execution of financial activities. Anytime you see the term managerial, we'll be talking about the functions of management, planning, controlling, execution. But now here we're talking about managerial finance, and here we are going to talk about planning, control, and execution of financial activities. So if you are noting down, the first point in a managerial finance function is called capital budgeting decisions. Number one is called capital budgeting decisions. So here the first point we have investment of long-term asset mix decisions. These decisions also referred to as capital budgeting decisions. I hope you're getting me clearly. Okay. So I'm talking about the first managerial finance function, and we are calling it capital budgeting decisions. Another name of capital budgeting decisions is investment decisions. The good thing about managerial finance functions, there are 4 of them, and these 4 represent 4 topics, 4 major topics in this unit. So if you see capital budgeting decisions, it is a topic on its own and a long topic that you're going to discuss. But today I just want to give you a hint of capital budgeting decisions. So these decisions relates to the allocation of funds among investment projects. So here we are talking about allocation of funds among investment projects. They refer to the firm's decision to commit current funds to the purchase of fixed investments in expectation of future cash inflows from these projects. So I just want to summarize what it means when you're talking about the ability to make investment decisions. Here we'll be talking about projects and the techniques that are used to choose some projects over other projects. For example, we'll have project A and project B. And we have techniques of choosing the best projects. So we'll also be talking about replacement decision. I hope you're getting me clearly. Okay, is there anyone I can see in my in-call messages? There's that you cannot hear me, or that was some times back. Okay, so I was talking about capital budgeting, and I was saying that we also have the aspect of replacement decision. So we have making investment decisions, and we also have the aspect of replacement. So investment decisions also relates to recommitting funds when an old asset becomes less productive. So sometimes in a company, we will have some assets that are less productive, especially in manufacturing companies. So they become less productive and we will need to replace them. Before we replace a machine, we need to make a decision. So there are some factors that you're going to consider for us to be able to make a replacement decision. Let's go to, so that is one of the managerial functions, capital budgeting decisions. And I've said it's a topic on its own. We also have financing decisions. So financing decisions refers to the decision on the sources of funds to finance investment projects. The finance manager must decide the proportion of equity and debt. The mix of debt and equity affects the firm's cost of financing as well as the financial risk. So financing decision is all about sources of funds to finance investment projects. So in this one is also another topic, and it's called capital structure, whereby we'll be talking about the two major sources of finance in financial management. The first one is called equity finance, and we also have debt finance. We also have debt finance. So under equity finance, maybe someone can tell us what is equity finance and what is debt finance? What is equity finance? Yes, Mark, you're saying something? Yes, what is equity finance? Equity finance. Oh, can you hear me now? Hello. Okay. So you're saying something about equity and debt finance? Yes. Mm-hmm. Yeah, sure. So thank you for that. So when you're talking about equity finance, an example of equity finance is retained profits. So profits, when you make profits from the company and you're able to use those profits to do projects, that means that is equity finance. So we're also going to look at another aspect of equity finance that is called shares. When companies want to get capital to invest in their projects, they normally sell shares. Anyone who has an experience of buying shares from a company, especially companies listed in Nairobi Stock Exchange, what is your experience? Your experience in buying shares or selling shares? Yes, anyone? Okay. Hey, no one has ever bought shares. Zachary, have you ever bought shares? Oh, Mark, you're saying something? Oh, okay. but you've ever heard of buying shares. Zachary, have you ever bought shares? Yes? Zachary, you're saying something? Yes, yes. Mm-hmm. Okay. Oh, nice. At what price did you buy Safaricom shares? Mm-hmm. Okay. So, were you buying shares for dividends or were you buying shares for profit? Okay. Thank you. So, in this unit, we will talk much about shares. And people buy shares because of two reasons. Number one, people buy shares so that they can get dividends. Number two, people buy shares for capital gains. For example, some people buy shares when the price is like Safaricom the other day, it was 13 shillings. I don't know right now the price. So, and then they sell. So the price can move up to 38 shillings or 30 shillings per share. Then they sell. So this unit you'll need to understand how shares work, because you are also going to do calculations of the aspect of shares. So shares is one way of equity finance. Companies are able to get capital when they sell shares to you. You become a shareholder. They use that money to invest, and then they give you profits in form of dividends. We also have the aspect of debt finance, and I think we have also discussed it. Debt finance, and a very simple example of debt finance is debt loan. Is loan from the bank, loan from the circle to invest in a project. So number two is financing decision, and I've said this one is also called capital structure. Let's go to number three. This one is a topic. I've said that. This one is also another topic. It's called division of earnings decision or dividend decision. Decisions. So the finance manager must decide whether the firm should distribute all profits to the shareholder, retain them, or distribute a portion and retain a portion. So when you talk about dividends decision, we are talking about a finance manager and his ability to distribute profits. When you buy shares in a company, we are expecting to get dividends. Dividends is what you get, the earnings that you get after the profits in the company have been divided or distributed. The best word is distribution of profits. So the finance manager must be able to make a decision on profits, whether to distribute all the profits to the shareholders, whether to retain the profits, or whether to distribute a portion and retain a portion, which this is what normally happens. Distribution of profits, we distribute a portion and we retain a portion so that you can be able to run the business. So there is always a percentage of profits that is distributed, but you're going to do those calculations. So that is about dividend decisions. Dividend decisions. The last one, number 4, is called liquidity decision. The firm's liquidity refers to its ability to meet its current obligations as and when they fall due. The ability to meet the current obligations as and when they fall due. It can also be referred to as current assets management. So we say that a company is liquid when it is able to meet the current obligations, and especially the current assets management. So what does that even mean in layman's language? When we are able to meet our daily or our current obligations, we can say we are a liquid company. What are some of these current obligations? Paying salary on time. Another thing is paying current assets, yani management of current assets. Why are we saying that there is need for management of current assets? Sometimes you can find, maybe it has ever happened to you, you have made investments, you have a piece of land, you have an asset in form of a car, but you are not liquid, meaning that all your money is investments, but you do not have the liquid cash to manage the daily activities of the farm or of the let's say a house, or maybe your business. So your business has succeeded, yes, in terms of maybe buying a piece of land, buying property, buying fixed assets. But when it comes to current assets, liquid cash becomes a problem. So there is need for a balance between the fixed assets and the current assets. So that is about liquidity decision, the ability to make liquid or working capital management decision or current assets management decisions. So this is a topic that is called working capital management, but here we are going to say liquidity decision. So these are the 4 main topics when you're talking about managerial finance functions. I don't know if you can be able to see my screen on routine functions. Routine functions. Okay. Let me just scroll. Just a minute, I share. Yeah, routine functions. So here I'll move a bit faster. So routine functions are the daily activities of a finance manager. So we have 4 of them as well. Supervision of cash receipts and payments, safeguarding of cash balance, custody and safeguarding of important documents, record keeping and reporting. So supervision of cash receipts and payments, these are the routine functions. The also safeguarding of the cash balance, safeguarding important documents, record keeping and reporting. So here I won't explain much because those points are just self-explanatory. So but I'll insist on the managerial finance functions. There are 4 of them, and you also have routine functions. There are 4 of them as well. So in the next lesson I'll be able to share a past cut paper or a past paper that is talking about the managerial finance functions. So we will go to our next part, which is objectives of a business entity. Objectives of a business entity. So every time you have a business, we have some objectives. So profit maximization is one of them. Shareholders' wealth maximization, social responsibility, business ethics, and growth. I would like you to go through these, but I know we are going to talk more about shareholders' wealth maximization. So some people start business for profits, others start business for wealth maximization. We also have the aspect of social responsibility, business ethics, and growth. That one I think you can go through that. So I hope everyone has this document. This slide has some mathematical question. So we are going to look at it later. Yeah. So the next part, I want us to look at agency theory. And I hope you're really getting me clearly. And in case you're not getting me clearly, kindly let me know. So I want us to look at agency theory. And this is a theory that is very important in financial management. It is a theory like any other theory. So if you don't know it, you cannot guess. But this one you can guess a little bit. So an agency relationship may be defined as a contract under which one or more people hire another person to perform some services on their behalf and delegate some decision-making authority to that agent. So when you talk about an agency relationship, we are talking about a contract, like any other contract. But now here, we have the aspect of some parties. Of course, in a contract, we have parties. When you have a contract, we always have parties. So in agency relationship specifically, we are talking about party number 1 called principal and party number 2 called agent. The principal hires an agent. Principals hire another person, the agent. What is the work of the agent? to perform some services on behalf of the principal and delegate some decision-making authority to that agent. So here we have, let's talk about, for example, property agent. Of course, their work is to perform duties or services of the principal, who is the owner of the building or the owner of the property. And that is all about the agency relationship. So it is a contract, that is number one. And in this contract, we have parties, principal and agent. Principal hires agent. Principal delegates some decision-making authority to the agent. So, for example, in property management or in house management, do you have house management? Let's say property management. So, the agent of the property is allowed to close the door if the rent is not paid. Performing services on behalf of the principal. So you can be asked this question: define agency relationship. I hope you can be able to explain. In finance, we have several types of agency relationships. Number one, shareholders and management. Another agency relationship is shareholders and debt holders, shareholders and government, shareholders and auditors, shareholders and headquarters office and branch. So mostly I'm going to focus on shareholders and management. And because in our next lesson we are not going to look at this, kindly make time so that you can go through the other types of agency relationships. So shareholders and management agency relationship: a limited liability company is owned by the shareholders. When you buy shares in a company, you become a shareholder. If you buy Safaricom shares, you become a shareholder in Safaricom company. But the truth is that you are not going to become a manager in Safaricom company. You are only going to become a shareholder. So that brings the concept of agency relationship, because we are saying that a limited liability company is owned by the shareholders but managed by the board of directors appointed by the shareholders. Why are we talking about agency relationship in a limited liability company? This is because there are very many shareholders who cannot effectively manage the firm all at the same time. We are saying that there is need for agency relationship in limited liability companies because there are very many shareholders. For example, in Safaricom company, there are very many shareholders, maybe 1 million shareholders. All of those 1 million shareholders cannot manage Safaricom company. Maybe because there is also the aspect shareholders may lack the skills required to manage the firm. Shareholders may lack the required time. So here we are talking about these 3 points. The reason why we have shareholders and management agency relationship, and the reason why we are delegating our role as the owners of the company to the board of directors. Number 1, there are very many shareholders who cannot manage the firm. Shareholders may lack skills. They may also lack the time, because when you buy shares, you're doing like an investment. So you buy shares in Safaricom, KenGen, you buy shares in Equity Bank, Absa Bank. You cannot have all that time to go again and work in those companies. That is why the aspect of agency relationship comes in. So this is a very common question about the conflict of interest. There is always a conflict of interest between managers and shareholders. A conflict of interest. What are we saying, or what do we mean when we say that there is a conflict of interest? When managers are appointed to work in a company, they have their own interests. Shareholders, they also have their own interests. They want to get dividends. They want the company to do well so that they can be able to get wealth from the company. So we have that conflict of interest between managers and shareholders. So number 1, you have the incentive problem. Managers have fixed salaries, and hence they have no incentive to work hard to maximize shareholders' wealth. So managers, they just have a fixed salary, so they just come to the office. There's no motivation to work extra hard to maximize their shareholders' wealth. If they perceive that they will not share in the benefit of their labor. So there's the aspect of incentive problem, where the managers become as in they are not motivated. So there's no need for working hard and all that. So we will have a conflict of interest in that scenario. Consumption of perquisite or perks. This time is it called perquisite ama huwa zinaitwa aje? So let me call them that. So managers may have themselves huge salaries and other benefits more than what a shareholder can consider reasonable. Of course, in a company, the managers can allocate funds so that they can have, there is need for a company car, company house, company resources, huge salary, and when this happens, the shareholders can feel that they will not be able to maximize wealth. So there is the aspect of conflict of interest. Another conflict of interest, let me scroll down. Different evaluation horizon. Managers might undertake projects which are profitable in the short run, while shareholders prefer projects which are long-term consistent. So, when you talk about different evaluation horizon, we are talking about projects. Managers can prefer just to do short projects so that they can show that the company is making profits. But these short projects will not be able to create wealth. So that means that the shareholders, they want the company to invest in long-term projects that will create wealth for them, and there we will have a conflict of interest. Managers may undertake projects that improve their image at the expense of profitability. So that means that there will also be a conflict of interest. So in the exam, for exam purposes, you can be asked about the conflict of interest between shareholders and managers. There is also the aspect of management buyout. You can do a research on it. And also creative accounting. I want us to go to the solutions. Solutions to conflict of interest. Because of this conflict of interest, the company will not function well. So there is need to resolve the conflict. You can also be asked ways of mitigating conflict between managers and shareholders. So we have number 1, incur agency costs. So the company has to incur agency costs in terms of monitoring expenses such as audit fees. So they have to monitor how expenses are being used so that they can be able to get more wealth. Expenditures to structure the organization so that the possibility of undesirable management behavior would be limited. So that one is also an aspect of agency cost. It is called the cost of internal control. And the last one is called opportunity cost. It is called the cost of delaying some decisions. So I want you to take your time and go through this topic because my main focus is the mathematics aspect. So for the theory, I just wanted to introduce you to the unit, and then in our next lesson we will start calculations with immediate effect. So kindly go through this document. By the time you see it for your cut, it should be in your fingertips. But we will be going through questions that can be asked in topic 1. So I've talked about incurring agency costs. We also have profit-based remuneration, whereby the shareholder may offer the management profit-based remuneration. So other than the fixed salaries, the manager... Yes, there's someone with a question. Okay. So other than the fixed salary, there's also the aspect of giving the managers shares, share options, profit-based salaries like bonus. Yes. So we also have the threat of firing and the threat of acquisition or takeover. So kindly just go through this document. I hope everyone has it. If you don't have it, kindly inbox me so that I can share with you. And this is our topic 1. So topic 1 is basically theory, just introducing the topic. But now when we meet next, we are going to start calculations. So that is all that I had, unless there is a question. Is it possible that we meet tomorrow at 7:30? Okay, thank you so much. Thank you so much for your time. Kindly make some efforts from the word go so that this work cannot be piled up. So let's meet tomorrow at 7:30 for the economics class. Thank you so much and have a